What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. We're going to do a breakdown video today, going through a video from the Money Guy show, exposing infinite banking apparently. And I've gone through it, and there's some good information. There's also some really bad information as well. And it's pretty misleading. There's a lot of half truths, a lot of straight up just inaccurate, wrong information. And that's the problem I have with this kind of stuff, with these types of hit pieces. It's not that people disagree with infinite banking. I couldn't care less about that. You know, if you don't like whole life insurance, you don't like infinite banking, I don't care. But don't lie about it. Don't provide misleading information just to promote your own narrative, because that doesn't serve people in the long run. I always say on this channel, guys, how are you able to make like an informed decision with your finances if you're getting wrong information? Like, you don't know what your options are. You don't know how those options work because you're getting wrong information. Like, it's really frustrating. And here's the thing, like, you know, somebody that implements the infinite banking concept in my own life, man, I can tell you, it's a really awesome and very powerful financial strategy if you set your policy up right, if you utilize it correctly. Okay, so it's definitely not for everybody, but it can be really powerful, and it can provide just an awesome and really strong financial foundation in our lives as well. So it's a lot of benefits to it. And that's why I want to do this breakdown video, to clarify and just clear up some of the bad information in this video, so that you can make the best decision for yourself. All right, so let's go ahead and hop into it, guys. My only ask is, if you find the video helpful, just hit that like button. Make sure you check out the links in the description as well. I'm gonna have a ton of additional training on infinite banking. We've got a masterclass down there. It's free. You can opt in for it. I also have a Facebook group you can join. And then I'll put some links to some videos showing you how I'm using my own policies right now, how I set them up, all that stuff to help you along in your infinite banking journey. All right, so let's rock and roll. Let's have some fun.
This infinite banking. Have you ever want to know what's the scoop? We got you covered.
Brian, I am so excited about this because this gets so much press and we get so many questions asking us about it. Guys, what about infinite banking? Is this what the elite wealthy do? Is this what the top rung of society is doing? Is this the secret financial thing that I need to know about in order to truly be a financial mutant? So in today's show, we want to unpack that.
Well, here's the thing that gets me is insurance is a very necessary part of the wealth building process. What I don't love is somehow in this modern world we live in, you cannot help but turn on social media and people will tell you 401ks are a scam.
Yep.
Yeah. So I'll let him finish his statement here.
And it's typically followed by, because where you need to be putting your money is in life insurance, whole life insurance, and even bank on yourself through infinite banking.
Okay. So let's clarify that. First off, I will agree, like, social media can absolutely be a problem with this kind of stuff. I see horrendous, just awful content and information around infinite banking, and people saying that 401ks are a scam. That's usually IUL agents. That's like he's saying, you know, do it with whole life or whatnot. The content that I see when they're talking about the 401k being a scam, it's usually an IUL agent or an agent trying to promote index universal life, which is the complete opposite. It's trash. I've done all kinds of videos on that. Check it out. But so I do agree that there's absolutely a problem with when it comes to the content on social media sometimes, 100%. That doesn't mean that the concept itself is bad. It's just bad information, right? Calling something a scam just to promote your own narrative and sell something else is really stupid. Like, if you have to do that, then maybe what you're selling is not as good as you think, because you shouldn't have to say how awful something is in order to sell it what it is that you're selling, right? So keep that in mind. 401ks are not a scam. I am not a fan of 401ks at all. I'm not a fan of relying on so heavily relying on the stock market to build our wealth. I'm not a fan of it. Does that mean it's a scam? No, I would never call it a scam. It's just a financial product, just like dividend paying whole life insurance. It's just a financial product. It comes with certain benefits, right? It does very specific things. And depending on where we're at in our lives and what our goals are, you know, 401k might make sense. Cash value whole life insurance might make sense. Maybe neither of them makes sense. It just depends on your goals and your current situation. But to call something a scam is just stupid. Same thing with infinite banking. Like, when people say infinite banking is a scam, no, it's not. It's just a financial strategy. That's it. And when you understand it, then you can make a decision on whether or not it makes sense for your specific situation. So yeah, but I do agree that the social media part of the industry can be a little sketchy.
I'm just glad that we finally have been able to find an insider that would share the details with us so we could do this content. So stick around to watch all the details on infinite banking.
Yeah, that's a great setup, Brian. What we've done is we actually have a listener out there to say, actually, I do this. This is a strategy I perpetrate. And every time you guys talk about this, you're not actually using policies that are designed for this specific purpose. So we asked this friend of the show, hey, why don't you send us some policy design so we can actually do a side-by-side case study to see if this is merited. But before we get into that, for those of you who don't know, for those of you who aren't familiar, infinite banking or bank on yourself is a way of—
and actually, I would just say too, like, I'm happy to share my like, I've done videos on my policies. I've done videos on how I'm using infinite banking or using my policies to implement infinite banking. So I'm happy to share that all day long with channels like this. So keep that in mind. Like, if you're watching this and you would like real life examples of this being implemented, just check out the other videos on my channel. 100%.
in which you use whole life insurance to build up savings and leverage cash values for self-financing. It may be pitched as an alternative to putting your money in a bank or putting your money in the stock market.
Okay, so that's a pretty good definition. That wouldn't really be my definition, but it's pretty close. Like, I'm glad that they clarify using whole life insurance, because I see tons of agents trying to tell you that you can use IUL for infinite banking. Here's the thing: just because you can doesn't mean you always should. Okay, IUL is an inherently very risky product. There's a lot of things that can go wrong. Not usually during the accumulation stages, like the growth phase of the IUL, but later on when you get older and you're taking income and all that stuff, that's where it can really cause a problem. But whole life insurance is what was meant to be used in order to implement the infinite banking concept. It's just the absolute best vehicle for it, because of all the benefits that we get. We get the guaranteed growth. We don't have to worry about volatility or anything. You know, a whole life insurance policy, that the cash value can never go backwards. It's guaranteed to grow, plus you get dividends, which those aren't guaranteed, but these companies have always paid them. So I do like that they make that distinction. Let's see, to build savings, correct? It is a very efficient savings vehicle. It's not an investment. Leverage cash values for self-financing. That's one thing that you can use it for. I use my policy to build wealth, take advantage of investment opportunities, alternative investment opportunities. So private money lending, I'm flipping heavy equipment, things like that. But you can use it for self-financing as well. I actually used my policy to purchase my vehicle. Right. And I've done a lot of videos on this, why I think using a policy is the best way to purchase a vehicle. I'm not going to get into all the details right now, but needless to say, like, the main benefit there is that I eliminate the lost opportunity cost of paying cash or financing through a traditional bank, because I'm not able to recapture any of that. That money is gone forever when you purchase a vehicle like that. Versus in the policy, when I borrow against my policy or borrow from my policy, I'm borrowing the life insurance company's money. I'm not withdrawing my own or using my own money. So my cash value continues to get that uninterrupted compound growth while I use the money to purchase the vehicle, and then I pay that loan, that policy loan back. It restores the cash value dollar for dollar minus the interest, which goes to the life insurance company. But I'm able to recapture those dollars while my policy continues to grow uninterrupted. It's really, really powerful. Let's see, it may be pitched as an alternative to keeping your money in the bank or investing in the stock market. So a couple things there. I definitely agree with the bank part of it. I've done videos on this as well. I do not trust the financial system whatsoever. I don't trust banks whatsoever. If you just do your research and look at the history of banks, they actually have a terrible track record and resume of being a safe place to store money. Tens of thousands of banks have failed over the last 100, 150 years. These mutually owned life insurance companies have weathered every single financial disaster, chaos, storm, call it whatever you want. Not only have they survived it, they've paid dividends through all of it. These companies have never missed a dividend payment. So is it an alternative to keeping large amounts of capital in the bank? You bet you. From a safety standpoint, 100%, not to mention, what is your money doing in the bank, right? What is it? What benefit do you get from it? Is it growing, getting uninterrupted tax-free compound growth? Do you have the death benefit? Do you have living benefits? What happens when you withdraw the money and use it? That money's gone forever. It's stopped earning interest. That's not the case with these policies. So I do still have some money in the bank. All right, I would never say to take all of your money out of the bank. All right, but the large amount of capital that I have to invest and run my business and just to save as an emergency and opportunity fund, I move the majority of that into my policy. Now, comparing this to the stock, like being an alternative to the stock market, I don't like making that comparison. Like, here's the thing: why not do both? Right? Why does it have to be one or the other? Because with a properly designed policy where you have access to high cash value, like if you're so confident in the stock market, well, why not set up the financial foundation first with this policy, borrow against it, put the money in the market? Now you're making positive arbitrage because you borrow at 5.5 and you make 8, 9, 10%. I don't like those numbers. I don't like when people say you make on average 8, 9, 10%, 12%. Like they're using average rates of return to value this investment opportunity. I really, really don't like that. I'm not a fan, and I'm not telling you to do this. This is not financial advice. I actually don't like the stock market very much at all. My point is, it doesn't have to be either or. If you are that confident that you're going to get the 12% on average every year that Dave Ramsey tells you you're going to get in mutual funds, why not set up the foundation first, get all the benefits of the policy, borrow against it, pay a little bit of simple interest to set this up, put the money in the market and get your 12%. Like I do that with private money lending, or I'm going to be, where I borrow at 5.5% and I lend it out at 12 plus points. That's the positive arbitrage that you get. You're not trying to get positive arbitrage on the policy. You get positive arbitrage with what you use the policy for when you borrow against it, right? So I just wanted to clear that up. I don't think it has to be an either or within that conversation. So let's keep that in mind.
Instead, get to be the bank. So that's the pitch. You no longer need a brick and mortar. You no longer need a financial institution. You yourself can become the bank.
Now, look, I want to play the.
Now, real quick, just on that, I don't advocate for this completely replacing banks and credit unions and stuff. They absolutely still serve their purpose. You might not always want to use your policy for whatever it is that comes up. Maybe a traditional bank financing might actually make more sense. So just keep that in mind. It's not like, again, it's not one or the other. We're just putting our money in the most efficient vehicle possible that gives us a lot more control of our finances and a lot more benefits too, as well. So let's keep
the part of helping you kind of walk everybody through this. And sometimes when I see definitions, it doesn't really tell the full picture, Bo. So how about a visual? Do you have a flow chart or a visual that can help people who maybe are the learners who go beyond the words?
That's exactly right. So here's what you do. You as a policyholder, you're going to pay premiums or send cash into a whole life insurance policy. It's going to be a life insurance policy offered by an insurance company that you're going to pay a premium into every month. Well, with that premium, one of two things is going to happen. Part of it is going to go by a death benefit. If you were to die, a death benefit would be paid out to your beneficiaries. And the other half is going to go to build up cash value inside of the life insurance policy. Well, as that cash value then builds, you as the policyholder can then borrow against it. So if you need to be able to have money to spend, rather than going to the bank and pulling money out of a bank account, you can instead use your life insurance policy as the bank to pull money out of.
Now,
that was actually a really good visual. I actually like this, and pretty much everything you said was spot on. The only thing that I would address a little bit is like as you make more premium payments, you get more cash value, then you're able to borrow against it. Well, you can actually set your policy up to have access to cash value within the first 30 days. Like I took my first policy loan on my first policy within 2 weeks, to purchase my vehicle, and I set it up to where I had like 88% access to the money that I put in. I did a large lump sum. I did it's like 120,000 the first year, 25,000 per year after that. I did a whole video breaking that down. That's the only thing I would clarify a little bit, but I think this is a great visual of how infinite banking actually works. So this was good.
Use your life insurance policy as the bank to pull money out of.
Now, I already noticed something that's a little concerning to me, Bo, is that when I talk about life insurance, I'm very familiar with buying term life insurance, which is primarily you are buying the insurance. If something happens to you, you get paid, but it doesn't build up cash value, meaning that there's not an element of investing or making the premium level in a permanent way. But I also noticed the thing that gets me, this says whole life insurance. Why don't you tell us what variables or factors are needed to really set this up? Because that's already a unique thing to be whole life insurance.
That's right. In order, and this is what we were told again by our insurance insider, hey, you got to make sure that you're buying the right type of policy. And so let's talk about the elements that make up this infinite banking policy. The very first thing that you need, what you have to buy, is high dividend paying whole life insurance. Now, you immediately alluded to something, Brian.
This is correct. So you can, again, here's the thing is, can you, like I've seen arguments made about using a HELOC for infinite banking, your home equity line of credit. I see a ton of agents promoting IUL for infinite banking. Can you do that stuff? Sure. It doesn't mean you should. Why not use the most efficient vehicle possible, which absolutely 110% is for infinite banking? It's going to be dividend paying whole life insurance policies. And we're able to custom design them for high cash value so that we can borrow against them very early on in the policy. We have a lot of cash value early on. You're not waiting years to finally be able to get access to the cash value. Typically also when you set these up, your break-even point is very early on in the policy. It's not 20, 25 years down the road where you finally hit that break-even point. Those are traditional 100% based policies. My first policy is set to break even in the 4th year. My second policy, the 5th year. Right. So you can custom design these based on what you are trying to accomplish.
Immediately our spidey sense goes off when we hear you have to go buy whole life insurance, because we know all the time that we talk about term insurance versus whole life insurance. There's a very tangible reason why we like term insurance more.
Well, first of all, life insurance, I think, is a period certain need. Like hopefully the goal is you're saving and investing, you're building up your army of dollar bills.
Well, I'll let him finish.
So hopefully at some point you become self-insured because you're financially independent. You don't need to replace your income.
Okay, so all right, let's stop right there. So first off, here's the thing. He's talking about life insurance being a period certain product where at some point you don't need it anymore because the kids have moved on, the mortgage is paid, or whatever. Okay, I don't really like that logic. I don't really like that idea or concept. Because here's the problem when people are comparing term insurance versus whole life insurance, right? They're only talking about the death benefit. That's it. Like if you're only talking about the death benefit and that's all you want, then sure, get a term policy, I guess. I mean, there's even still an argument to do whole life though, because you can pay off a whole life insurance policy and just have it continue to grow, have the death benefit continue to grow, the cash value to continue to grow without even having to make any more premium payments. Like you could do that. So, there's an argument to even do whole life insurance, but if you're only talking about the death benefit, you're missing all of the other benefits that these policies give us and why. And like, that's the missing part of the story 9 times out of 10. Like they're not telling the whole story with that. They're only talking about the death benefit. So for example, if I were to say, for the same exact, let's just talk about living space, right? Renting versus buying a house. Well, if you have a house that you can rent or buy, it has 3 bedroom, 2 bathrooms, 1,500 square feet, and you can rent or buy it. And we're only talking about the living space. Why on earth would you ever buy a house? Right? Because you got to come up with the down payments. There's maintenance, property taxes, like all this stuff, right? It's so much more expensive to buy a house than it is to rent. So why would you ever buy a house for the same amount of living space, right? But do you see how I'm leaving out the rest of the story here? All of the other benefits involved with buying a house, creating the memories with your family, most importantly. You get to build equity. It's something you can sell later on down the road. It's something you can pay off. You have control of it. You can do whatever you want. You want to paint the roof blue. You could absolutely do that because it's your house, barring any HOA, right? But you get my point here, right? There's so many more benefits, so it's worth it to pay a little bit or to pay more to buy the house versus just renting, because we're not just talking about the living space. I hope that clicks with you guys, because that's my frustration with the buy term and invest the difference argument versus whole life insurance, because they're only talking about the death benefit. They're not talking about any of the other benefits that you get with these policies. What was the other thing that he said? Hang on.
need. Like you're hopefully the goal is
the whole concept about becoming self-insured, like because you're able to invest the difference, which most people don't do. Right. So let's be real about this. And then eventually you're going to build, but let's say you do, and you're going to eventually build all this wealth. Well, that's not guaranteed. Like, how do you know you're going to get 10, 12% every single year? And are you even putting enough money into it in order to reach the point where you can comfortably be self-insured? Like, I just don't think there's a such thing. You're either insured or you're not. You're either retaining that risk, or you are putting that, you're transferring that risk to somebody else or some company, right? It's either or. There's no such thing as self-insured, in my opinion. And that's a whole other rabbit hole. I'm going to do a separate video on that, but that's just another part of the conversation. Like, not to mention people don't account for inflation a lot of the times in those projections, but like, you just got to be careful with that kind of stuff and really figure out, like, is that in alignment with what you're trying to accomplish? Like, and are there better ways? Are there better vehicles? Is there a better strategy to help me get to where I want to go that's going to give me these contractual guarantees? It's going to grow every single year. It's going to be there for me when I need it. It's going to serve as that emergency and opportunity fund. It's going to accelerate the wealth building process. Like, when you start having that conversation, all of a sudden, these dividend paying whole life insurance policies, they sound a lot better than what these buy, term, and invest the difference advisors or agents will tell you. So anyways, let's keep going.
You're saving and investing, you're building up your army of dollar bills. So hopefully at some point you become self-insured because you're financially independent. You don't need to replace your income anymore because your assets will talk for you or protect you and your loved ones. That's not what I'm seeing here, because when we talk about whole life, the premiums are substantially higher. And I know
again, he's only talking that is true. It is far more, like, whole life insurance is far more expensive than term insurance, but for all the reasons I just explained, it goes back to that rent versus buying a house conversation. He's only talking about the death benefit there.
We even have some research on that.
Yeah, if you look at how much insurance coverage costs, and this is for a female in excellent health for a $500,000 policy. If you were going to go buy term insurance, it would cost her $188 at the age of 30. That same level of coverage for a 30-year-old would cost $4,000 a year. So $4,000 versus $188. Fast forward to a 50-year-old female in excellent health. If that lady wanted to buy a $500,000 policy, she's going to spend about $644 a month for that term coverage. If instead she wanted that same amount of coverage in whole life insurance, it's going to cost over $9,400 a year. So these are very different.
Again, he's not telling the whole story here. So I'm going to keep this up because we're going to use this chart here. So he's talking about cost here. Again, I have to stress this, guys. I feel like I'm beating a dead horse here, but I just really want to make sure that we get this point home, is that he's only talking about death benefit. He's not talking about all of the other, like the rest of the value that you get for your dollars here. So like when he's talking about, in this example, the 50-year-old, it costs $9,443 for the same coverage. Okay, again, if we just stop at death benefit, that's true. But also this, when you design these policies for high cash value, you have access to a large portion of this money to serve as an emergency and opportunity fund. You don't get that with a term policy. All you get is the death benefit. What happens if you get diagnosed with a chronic, critical, or terminal illness? Is your term policy going to pay out a portion of that death benefit so you can get the care that you want? Some might. There are some term policies that do come with some living benefits, but they're usually not anywhere near as good as what you'll get from a whole life policy. Right. Not to mention that death benefit is going to, with a whole life policy, is going to be there for forever as long as you have the policy. You can pay it up just like you can pay off a mortgage on your home. Right. And you can continue to get that growth, that tax-free compound growth. You can continue to have that increasing death benefit and leave a massive legacy to your loved ones, which also in retirement allows you to spend and utilize your other assets more freely. Like, it gives you permission to use all the wealth, all the assets that you've accumulated, because you don't have to worry about replacing your income. You don't have to worry about, because you have this whole life policy, you don't have to worry about, if you were to get sick or whatnot, because guys, I think it's something like 70% of bankruptcies when people get older are due to medical expenses. People are not prepared for this. Do you really think you will have acquired so much wealth in the stock market that you're going to be able to afford your long-term care, medical expenses, et cetera? I mean, really think about that, guys. And that's another major benefit of these policies that is often glazed over. And especially when we're talking about buy term invested difference versus whole life, like, it's just misleading. It's not telling the whole story.
Different when it comes to costs of getting that insurance coverage in place.
But it's called permanent insurance for a reason. This is meaning you're planning on buying this policy and holding this policy until you pass away.
Yep.
Whereas term, as the title kind of alludes, is only for a period certain of time. So I'm a little confused on that, but I'll let you keep us on this journey.
So specifically, you want to make sure that you're buying high dividend paying whole life insurance, because you can use other types of permanent insurance, but dividend paying, or also known as participating policies, are the ones that work best. And there's a few reasons why they work best. Number one, the premiums don't go up as with other policies. So you can actually lock in a fixed premium for the life of the loan. The other big way.
Correct. Term insurance gets more and more expensive every single year. It's also why I'm not a fan of index universal life or infinite banking. There's just so many problems, so many things that can go wrong. So that is correct.
That these policies are sold is that the cash values are guaranteed to go up. If you look at other types of cash value whole life policies, they have a guaranteed rate that says no matter what, we're going to make sure that this goes up. Not all cash value policies work that way. Some of them can actually decrease in cash value. But if you buy a guaranteed whole life policy, you can assure that you're going to have some minimum rate of return that you receive. Now, here's the problem, though. When it comes to buying whole life insurance, there are often a lot of very expensive commissions, very expensive fees that go into this. So,
oh man, the commissions argument is just really annoying, to be honest. Like, he's not wrong. There's commissions involved, but here's the thing, guys. If you have a problem with commissions, don't ever buy another financial product again. Don't ever work with a financial advisor. Don't ever buy term insurance. In the financial industry, that's how people get paid, through commissions. And so, like, the way that whole life policies work, like these custom designed ones for infinite banking, we actually take a very big hit on our commission because of how we design the policy, where we lower the base, we lower the death benefit, we increase paid up additions. That has a very negative impact on our commission, but we're okay doing that because typically when you get into this industry and you start setting these policies up, you do it because you want to do what's right for the client. Like, we truly, really want to help people put this amazing foundation in place. And so we're not worried about that. We still get paid well to do it. Okay. So if there's nothing wrong with commissions, there's nothing wrong with people making money. It's like, what is the value that you're getting here? You're talking about setting up your own private banking system that is going to compound and grow every single year for the rest of your life. It's going to provide this great death benefit, living benefits, et cetera. It's going to allow you to use the money to build wealth. Like, what's the value of that? How do you put a price tag on it? Not to mention, you don't pay the commission to the agent. The life insurance company does. And when you look at your illustration, all of that is already baked into the policy, into that illustration. When you look at the illustration, that's net of commission, fees, et cetera. So that's number one. Number two, the hypocrisy of this argument, though. I don't think he's saying that he has a problem with the commissions. He's just pointing certain things out, but not telling the other side of the story, where advisors, when they make that 1% to 2% every single year assets under management, do you know how much money that turns into over the long run? Because here's the thing too, with whole life policies, we get paid the first year. We do get like some commission. Sometimes it's up to year 10, but it's very minimal. It'll be like 1% or 2%, if that, of the premium payments, not the value of your account. See, with advisors, with assets under management, as your account grows, that 1% or 2% stays the same, but it's 1% or 2% on a higher account value, right? So they're getting more and more and more as your account grows. Maybe that's good, maybe that's not. It's a whole other conversation, but they also get paid if your account value goes down too. So what are we talking about here? Like, why are we bringing up commissions? I just don't see how that's relevant at all, especially since you as the consumer don't pay that commission directly to the agent. It's the life insurance company that does. When it's assets under management, you are paying the advisor, the investment bank, whatever, whoever you have it set up with. So I just don't like that argument. I don't see how that's relevant to the infinite banking concept itself.
Consumer Reports came out and said, hey, when we look at all the different cash value whole life policies out there, the average rate of return, and this is including the dividend payments, but with the guaranteed cash value built in, is only about 1.5%.
Wrong. So if you're talking about like how policies are typically set up, they're not set up for high cash value. They're not set up properly. Then yeah, the rate of return will be lower. But here, a couple of things about this, guys. We don't set these policies up for rate of return. Okay. The rate of return, the internal rate of return that we get is just a bonus. The real rate of return is us, how we use the policy to accelerate the wealth building process. And then to counteract like the what do you say, 1.5%? When you design these properly for infinite banking, these policies will typically get 3.5 to 5% net tax-free compound growth. My first policy, by the 30-year mark, will have been doing 4% every single year for the life of the policy. My second one, I still have to, I forgot what my second policy is. I think it's like 3.7 or something like that. But you know, that like when you compare it to the stock market, does that sound really good? No, of course not. But we're not, like, this has nothing to do with the stock market. Whole life insurance, it's not an investment. So you can't compare it to an investment. This is a savings vehicle. If I told you that down the street, there's a bank that's going to pay you 4% tax-free compound growth for the rest of your life, it's going to allow you to use the money in the account to go and build wealth without interrupting the compounding process, and it's going to pay out a massive income tax-free death benefit if something happens to you, it's going to pay that to your loved ones. Does that sound like a good savings account? Yeah, that sounds pretty sweet. That's exactly what these policies are. They just happen to be life insurance. So it's a perspective issue as well when we're talking about these things, just how you think about it. Because like if you're comparing this to the stock market, well, yeah, 3.5% doesn't, or 4% doesn't sound very good. But what about all the other benefits? Like, what are we actually setting up here? Like, you wouldn't compare a savings account to the stock market, would you? So why are you comparing stock market returns to dividend paying life insurance? It just doesn't really make any sense. All right, let's we'll continue a little bit longer. I might actually end up breaking this up into two parts because we're already at the 31-minute mark, but we're only 7 minutes into the video. But I hope you are finding this valuable. I really want to go into depth on these things and just so that you understand how these things actually work. Therefore, you can make the best decision for you.
Per year. So if you look at the average of all the policies out there issued, the average is 1.5%. Now, we're going to talk more in a moment about how we're going to try to use a policy that's custom built to satisfy infinite banking. But right there on the start, even though there's a guarantee at 1.5 or around 1.5 does not get me super excited.
That doesn't completely shock me because whenever I hear the word guarantee, when you're talking about financial products, that's a heavy burden. That's a word, like I know when you're doing securities training, they tell you never, ever, ever use the word guarantee because that's something that, I mean, if you are taking.
It's funny too, because I see IUL agents all the time saying that you can never lose money in an IUL. Basically, I mean, that's a guarantee type of statement, but they do it all the time. I don't know how it's legal. Don't know how they get away with it. That's pretty crazy.
On risk, you that by its sheer nature is not. It's you're getting risk. You're taking a risk to reach a premium in return. There's a risk reward from that. A guarantee has to be at a lower price point, and that's why there's fees. There's lots of other things. I completely get why a guarantee is going to be a much lower rate of return.
So the first thing we're thinking about the elements that you have to have is you have to have a high dividend paying whole life policy. The second thing that you have to have is a lot of cash. So this is a little bit counterintuitive. In order to be able to execute an infinite banking or a bank on yourself strategy, you have to already be someone who can dump tons of cash into these policies. So right there off the bat, that's fairly limiting, right?
Yeah.
Okay. You don't have, he's making it sound like you have to have hundreds of thousands of dollars in order to do this, or like a ton of money. It absolutely does make sense if you have large amounts of capital in the bank, because like, what is your money doing in the bank? You know, it's not, what is it? I should say, what is it doing for you when it's in a checking or savings account or whatnot? It's barely earning any interest. That interest is taxed. It's not safe from creditors. It doesn't blossom into a massive death benefit if you pass away unexpectedly. It doesn't come with living benefits. It doesn't compound, like truly compound, get tax-free compound growth. If you spend the money in the account or you use the money in the account, that money's gone, no longer earning interest. So there's a lost opportunity cost to that. It's the exact opposite in a policy. So it makes more sense if you're saving money for emergencies, opportunities, and wealth building opportunities, then it makes sense to store that money in a much more efficient vehicle, which is a dividend paying whole life insurance policy, right? But you don't have to have hundreds of thousands of dollars. You don't even need tens of thousands of dollars. What you need is to be somebody that is first off focused on increasing income. Number one, that you have to get your income right first. right? Because you have to get to a point where you are able to save far more than what your bills are, what you're spending. You need to be able to consistently save money, because again, this is a savings vehicle, guys. It's not like we're just going to dump money in one time and it's going to fix all of our problems. No, this is a savings vehicle that just happens to be like it just happens to allow us to use it as our own private banking system, right? But so you need to be able to save money on a consistent basis. If you're not, then you don't even need to be learning about infinite banking right now. You need to be learning how to increase your income, right? Go from 50 to 100,000, 100,000 to 200,000. Like, always be increasing your income. Then once you get to a place where you've saved money, you have money coming in, your bills are paid, easy, you're saving money every single month. Okay, now we can have the conversation about, where should I save my money? Where should I start to put my money, right? This is, guys, this is the exact journey that I went down and how I got into this industry. I built my business, I built up my income, I saved money. And then eventually I got to the point where I was like, okay, I got this capital here. I want to make sure I'm putting it in the most efficient vehicle possible. Just so happens to be dividend paying whole life insurance. Okay. Bare minimum to do this is, and I might actually increase this, but like the bare minimum that you need and want for an infinite banking policy is probably around $10,000 the first year, and then maybe $2,000 per year after. You can still benefit from a policy like that. It's not going to be as effective as a policy that where you're able to put more into it, because again, we're setting up our own private banking system. So if I only put five, like, that's why I don't like seeing people setting up policies for $200 a month, $300 a month. No dumping, just nothing like that. It's like, that's not going to move the needle enough, right? You've got to increase your income first so that you can fund this thing properly. Okay, you're better off putting that $200 to $300 back into yourself to learn a new skill set or get better at what you're doing to increase your income. Now I'm making more money. I'm saving more money. Okay, now I can properly fund a policy. All right, but I just want to clarify that you don't need to be like super wealthy or anything like that. It's just, you have to have your income in place first, be able to save money on a regular basis. Then it makes sense to consider these policies. All right, I'm going to let this go a little bit longer, and then we'll wrap up and do a part two.
Because not everyone has a ton of excess discretionary cash flow that they can throw at this kind of policy. And so the question you may ask is, all right.
That's correct. That means it's not for you. That, like I say this on my channel all the time, infinite banking is not for everybody. Maybe eventually, but it depends on what your financial situation is. If you can't afford to fund the policy properly, well, you have a different problem than what you're trying to solve with infinite banking. Your problem is income. You have to get your income fixed. So.
Well, why do I need that? What do I want to be happening with this tons of cash? Well, what you essentially want to have happen is part of the cash you're putting into the policy is going to pay for the premium. The other part, and the premium being what the insurance actually costs, the other part is going to go to building up the cash value. What you want to do by dumping as much cash into this policy as you can is you're buying paid up additions. And what paid up additions are entirely paid for life insurance additions that both increase the death benefit, increase the cash value, and thus increase the dividends that are paid out. So for infinite banking, this paid up addition is primarily used to increase the cash value as much as possible, so the dividends that pay on that cash value are as high as possible. Mm-hmm. No different than if you had a bank account. You want to put as much money into that bank account as possible so that the interest or the dividends you earn on that is as high as possible.
Now, wait a minute. Mm-hmm. When I watched the brochure.
Okay. I got no gripe with that. I thought it was a good example. Obviously there's huge difference between putting money in a bank account and life insurance, but I don't think he wasn't comparing it. He was just making an analogy there. So I agree with all that. That's fine. Let's see. I'm going to go ahead and wrap up there. We'll do, we might even break this up into 3 parts. We'll see. We'll see how much we get through in part 2, but I hope that was helpful, guys. If you have any questions, comments, drop them, or feedback, just drop them down in the comment section below, and make sure you take advantage of all the additional resources I have in the description, all about infinite banking, dividend paying life insurance, and all that stuff. It's just me sharing my journey, things that I'm learning, how I'm implementing these policies and this strategy in my own life. It's been an absolute game changer. It's so powerful. Just have to know how they work. That's it. All right, make the best decision for you. All right, so I will link it down below to part 2 whenever I get that done. So make sure you check it out. So we'll continue this conversation. I think it's pretty productive. And but yeah, until next time, I hope you guys are crushing it to your success. Matty S is out.